Hi everyone, in today's video we're going to discuss Chapter 13 of The Intelligent Investor by Benjamin Graham. Chapter 13 is a comparison of 4 listed companies which were chosen by Benjamin Graham on the S&P 500 list. In the analysis provided by Benjamin Graham is comparing these 4 companies, trying to understand which one would be better suited for the intelligent investor. In doing so, it takes into account some key ratios which relate on the one hand to performance and on the other to price. So the focus will be on performance on one hand and on price on the other. Let's start with performance. When looking at performance, the first thing that comes to mind is the profitability. In order to evaluate profitability, Benjamin Graham uses the net per share on book value ratio. This ratio measures the company's net income as a percentage of their tangible book value. The second ratio that was taken into account was the stability. The stability was evaluated by considering the maximum decline in per share earnings in any of the past 10 years as against the average of the 3 preceding years. If there is no decline, then it's 100%. If there is a 1% decline, then it's 99%. Of course, the highest the better. The third element that was taken into account to evaluate performance was growth. However, although growth can be taken into account, it is also important to understand that past growth does not automatically reflect into future growth. The fourth element that was evaluated in the performance analysis is the financial position, and here the ratio was asset to liability. A good financial position translates to an asset to liability ratio of at least 2. Therefore, current assets need to be at least double current liabilities in order for the company to have a sound financial position. And finally, the last element that was taken into account in the performance evaluation was dividends. Although dividends may not necessarily be an element of performance, it was taken into account, and it has always been taken into account by the value investor. What really counts in dividends is the history of continuance without interruption. At least 10 years is more than enough to check this box. Let's move on to price. So when looking at the price, you have to look at price history, so how the price has evolved over the time, and whether there is some inflation in recent period due to better than average market action. But also you have to look into account that price as compared to earnings, and that's the PE ratio. The PE ratio is extremely important, and as we will see, even though a company may be profitable, if it's sold at the wrong price, as a matter of fact, it's not attractive for the intelligent investor. This leads us to the key takeaways of this chapter, which are basically 3. Number 1, high valuations entail high risks, which means that if a company has a very high PE ratio, it means that the price is very disconnected from the book value of the company. And this in future might lead to higher risks. Number 2, it is often more difficult to continue to grow at a high rate after volume and profits have already expanded to big totals. Number 3, high PE ratio may be justifiable only if, after an in-depth study, the financial analyst can come up with exceptionally firm and optimistic conclusions about the company. But not for the careful investor who wants to be reasonably sure in advance that he is not committing to the typical Wall Street error of over-enthusiasm for good performance in earnings and in the stock market. These were the key takeaways of the Chapter 13 of The Intelligent Investor. And thank you for watching. Don't forget to subscribe if you liked the video and watch my other videos on the Intelligent Investor and Finance. Bye everyone.